informative episode of Finance Footnotes. I'm your host, Brent Stransky, joined as always by my friend and colleague, co-host Zach Miner. And we've got a lot to cover today. We're going to talk about what to expect through May. You're familiar with the sell in May and go away. We're going to talk a little bit about that. We're going to talk about one reason to be optimistic going into the summer. We're going to talk a little bit about the Federal Reserve's policy. That's been the point of question for the last several days. And then finally, I'm personally going to end by sharing one place where I think we can find value for investments going into the summer. Zach, what do you have for us today?
I'm going to jump in on your last theme of valuation there and talk a little bit about the usefulness of those various valuation indicators and talk about what they are, what they aren't. Folks talk a lot about the various ratios, and I think it's helpful to understand a little bit of context about them.
Personally, I can't wait. So let's press on. We'll start, as always, with just a look of where we are. And so this clip I have on the screen today is taken from the Wall Street Journal this morning, and it does show the three primary stock indexes here in the U.S., the Dow Jones, the S&P 500, and the NASDAQ. And I think it's interesting, exactly. You and I spoke just 2 weeks ago, and markets were in the middle of their first correction of the year, down close to 6 or 7% at the trough. And then, as of yesterday, and today is slightly positive, but within a little over 1% of all-time highs, about the same on the NASDAQ. So since you and I spoke last, there has been a bit of a recovery here in the large cap indexes, which is just kind of a litmus test for where we are. I'm going to bring in here on this next slide. I have never heard the May indicator called the Halloween indicator. Have you heard that before? I'm sure you have.
I have not. Oh, is it
okay?
Wait until Halloween to buy back in?
Is that what that means? I think that was it. Yeah. So kind of wait to Halloween. So this is the sell in May and go away. It's a famous idiom here in the marketplace, but it was just some interest here. Is kind of pulled into in the Wall Street Journal over the weekend, an interesting article. And there's this confusing graph on the screen right now for those of you folks watching it at home that only a professor at a college could come up with, and that's in fact the case here. This graph is ugly, but I was able to pull away a couple bullet points here on the sell in May and go away. Over the last 23 years, going from November through May, which would be the Halloween indicator, the stock market has averaged 13.3%. with a volatility of 17.5. Compare that to the other 6 months of the year over that same time frame, and the index averaged only 8.6% annualized and a 14.3% volatility. Now, I did correct for the risk adjustment here, and if it was equalized in terms of risk, that return would be closer to double digits. So, my initial takeaway here is that it's a pretty attractive return for 6 months out of the year over the last 23 years. What do you think when you see this beautiful chart, Zach?
There's a lot going on there. Now, if that said negative 8.6%, then maybe there'd be some validity to staying out of the market during those time frames. But I think that missing out on 8.6% annualized returns is not a particularly strong way to go about managing your portfolio.
Yeah, it seems to be pretty attractive. Now, this professor who's from George Mason University did kind of break the data up from 1950 to 2000, and then from 2000 to 2023, and there are bifurcated outcomes. But I think the last 25 years or 23 years is good indication there. So that's what I wanted to concentrate on. You may hear some people talking about selling in May and going away. I wouldn't do it if I were you. Most of the time, everyone's different. Of course, consult with your professional. I want to talk a little bit about pessimism. We were talking earlier this year. It seemed to me that things were really euphoric in the marketplace. But I want to talk about two instances where I've seen some pessimism creep back into the marketplace. And this is really interesting. This is a fact. Both of these points are from Barron's over the weekend. But the institutional bear bull ratio, these are the folks that manage big funds, right? Billions of dollars, and they can be bullish or bearish, right? You're a bear if you think the market's going down. You're a bull if you think things are going to improve. And so this is really interesting, Zach. It dropped from a ratio of 3.9, meaning that there were 3.9 bulls to bear, to 2.1. So almost a halving in 1 week, and it was 2.1 last week. All that means is that it's the fastest drop in over 6 years of institutional money managers. These are the smart folks on Wall Street becoming more bearish. Pair that with, this is my favorite indicator, and we've talked about it before. Not my favorite indicator, one of my top. It's just the equity put call ratio. And that's the green line here in the chart. As you're following along, I have an arrow kind of pointing to it. This just is a quick measure of the fear in the marketplace. And I really like it because it's people putting their money down, taking bets to either protect their money or to profit from upsides in the marketplace. And so what we can see here is that it troughed, it was very low, meaning there was very little fear in the marketplace in February, March, and April. And you can see since then it's picked up significantly. And what's important about this is that it seems to me in my limited experience that investors are typically wrong, right? If everyone's doing one thing, you might want to do the other. So case in point, if you look towards that peak in this green arrow or this green chart here, October, November of 2023, that would have been the peak in pessimism based on this indicator, and also probably about a great time to get back into the marketplace. So those are just two indicators that seems to me pessimism, creeping in again, which is typically, I believe, a good thing for the markets.
Yeah, no, I to agree with all that. And there was a couple other similar indicators. One of the overbought things that we had looked at a few weeks ago had come back under, that range. Margin leverage had pulled off a little bit, and so they're all kind of moving in the same direction.
Yeah, I was really surprised by that statistic. Anytime you see an outlier like this is that first point about the institutional bear bull ratio dropping from 3.9 to 2.1. That's a very seismic shift. A couple standard deviation move for those statisticians. I need my second coffee. Sorry, folks. That's the biggest move in 6 years. That's something that kind of has our ear peak up a little bit. So just something I want to share with you. I believe it's in aggregate a good thing. So that being said, I want to just move forward here. Just a thought about the Fed pause. The jobs numbers came out on Friday, and they were a little cooler than expected. Still great, but it took the pressure off the Federal Reserve to be forced to pause their cycle for longer. The market is expecting a decline in rates here at some point down the road. I'll touch more on that in a second. But this is just a chart that was in the Wall Street Journal over the weekend. It's talking about the length of time it's taken since the market raised rates and when they lower rates for the first time. So you can see here, this is the last 7 indexes. The top July was when they raised rates the last time. So we're coming in on going to that next slide. Almost 300 days. So the last 6 rate cycles or pauses since 1989 have averaged an annualized return of 13.1%. So this is my reason we might want to still remain optimistic. The market is pausing and looking towards a decline, which is confirmed by the data end of last week. And things look pretty good when that happens typically. And then just for reference point, and I didn't realize this, Zach, maybe you did. It's almost been 300 days, which makes sense. But the longest since 1950 was in 2006 and 7. It's 446 days, over a year and 3 months, that the Federal Reserve was pausing for their rate cycle. Any thoughts there? I see you. Actually, I see you added something. So let's just move
this. This is one of the charts that was at kind of near the end of mine. But I thought while we're talking about it, makes sense. The number of days is a little bit different though. That 2006, 2007 one where you had it at 446, this says 319, which is interesting.
I wonder if this is trading days versus actual days, calendar days.
There you go. See, you're so observant. Yes. Yes. So I think that what I took away, what I wanted to point out with this particular chart is that the longer pauses, i.e. stronger economies while they're waiting, tend to be the stronger performing times in the market, right?
No, this is a great chart. Great.
If you have a 17-day difference from, it's like you just hiked 17 days later, you're cutting. Not great. 31 days, 22 days, right? The much shorter time frame turnarounds, which were all in the 80s, right? This was the the inflation troubles, the Volcker era, and or pre-Volcker. You had to turn around and make a change of course very quickly, tended not to be under great circumstances. But it looks like the longer ones where you have some time tend to be more positive situations. And there's some folks are saying like, oh, we're gonna have the hard landing, the soft landing, and it's like, well, it already kind of is a soft landing, right? I mean, inflation has significantly decreased, and unemployment is still low. The economy is still strong. Companies are still earning.
Very low.
And we're kind of in a pretty good situation with the economy. It's running a little bit hotter than I think the Fed or market participants had wanted. Interest rates are probably a little bit higher than we had wanted at this time, but ultimately things are pretty good.
Confirmed by Jay Powell on Friday during his comments.
Exactly. Yeah.
So, and that's I don't think I put this on the slides there, but a point I want to mention that was in the paper this morning is that you can take bets, and some people do, on whether or not interest rates are going to be reduced this year by the Federal Reserve. And according to CME, who measures that, as of Friday when the chair made his comments, 90% of market participants who are betting on this expect that rates will drop sometime this year. Not by how much, but just that we're still on track for at least one cut this year.
And Powell's comments were really focused, I think, on stopping the narrative that the next move is going to be a hike. He didn't necessarily say that there's going to be a cut in the immediate future. They continued to say that they're going to be wait to see their inflation targets be met. But he had a couple questions during the Q&A about like, hey, what are the possibilities of a hike? And he pretty much said that bar is very high, for us to have to resume hiking. He was very adamant that was more than likely not going to be the next move. And I think he wouldn't necessarily have taken that strong of a tone with it if it wasn't. So I think that they're, and they look at a different indicator than CPI, right? They look at PCE, which never got as high as CPI, never got anywhere near the 9%, right? I think it topped out at 5.6.
And for those folks at home, could you remind us what
the
different
personal consumption expenditure? It's just a different way to measure inflation.
Is that the one with the chain goods, the chain inflation? With replacement of goods, like if beef is up, we can buy chicken for cheaper, etc.
Yeah, exactly. And so cool. It just it's their preferred method or their preferred indicator. And that one I believe last reading was 2.8%, 2.7. So they want to get it down to 2, but they're not looking at the CPI at 3.6, mid 3% range. They're looking more at this other PCE indicator.
And all these numbers cut out, what is it, energy and mostly food prices, the most volatile,
the more volatile. Yeah. And they also look at super core, which takes some of that stuff out as well.
We spoke last time when we were together about the oil prices and how they remain so stable in spite of all the conflict emerging in the Middle East. Even since that time, it seems to me oil prices, I think, are down almost 10%. I mean, we're looking at West Texas in like the high 70s. It's really so that's coming down as well. That will help the consumers going into the summer driving season. That being said, let me move on to another slide, which is tangential to this conversation because it's what are people worried about? It's inflation, right? So Barron's Magazine is a big periodical for folks in the industry. I reference it often, but they do a big money poll every 6 months. And in this case, they polled 120 institutional money managers and financial professionals on the 18th of April. So this data is already 2 and 3 weeks old. And since that time, we've seen a little bit of positive information come out last Friday on the inflation numbers. So take that as well. But I just wanted to point out a couple of things here that I thought were really interesting. So number one, they asked them, what is the biggest risk you see to the stock market going forward in the next 6 months? And 29% of them thought resurgent inflation would be the biggest cause for concern going forward, followed by geopolitical turmoil at 14%, and then kind of diminishing from there. So definitely resurgent inflation is the biggest concern that these money managers think is on the horizon, despite everything else we see in the newspapers, which I thought was interesting. So that certainly is the tail that wags the dog. The second chart I have on this particular page, and I mention this only because these are the same people who in 2022 predicted with 100% certainty that there would be a recession in 2023, which never emerged. So we have to remind ourselves from time to time that even professionals can err. But I thought this is intriguing because I think they're asked what is the most likely sector to do well over the next 12 months, and you can see that most of them liked technology. So a full third thought tech stocks would outperform, followed by energy at 21%, and then the least likely to succeed, real estate, 29% thought that would be the worst performing sector, and so on. It could as easily be the inverse of this. Perhaps, the best performing in the next 12 months could be real estate. So we'll have to wait and see what transpires there. But gosh, the technology to lead again for the next 12 months seems like it might be a bit of a stretch. What do you think, Zach?
Well, Utes have been the one of the best performers year to date, definitely over the last 30 days. If you look at the utilities, let me see what they're, just look real quick. The Utes are up, almost 10%. Communications and energy up a little bit more, but one of the better performing sectors. So You take all of these with a grain of salt when you
And
make these
and
types of
my
predictions.
point is, and we'll have to come back and revisit this, but it could be the exact opposite. Is my point. It could be that real estate, which is
Yeah,
down significantly, could be the best performer. That's a value proposition. We'll have to wait and see. But
it
I
is.
just thought it was interesting.
It is interesting that the on the left chart there, pretty much the top three things are all ways to say the same thing. Resurgent inflation, geopolitical turmoil will, could potentially cause resurgent inflation. No reduction in interest rates, that would probably happen because there's resurgent inflation. So it's kind of, kind of saying the same things,
Negative feedback
in
loop.
different ways. Yeah.
Yeah. Gosh, we'll have to wait and see. I mean, it's definitely the topics that have been in the newspaper for the last 12 to 18 months, it seems to me. So we'll have to wait and see what happens there. And just the next to last slide I have here today, just again for that Barron's Big Money poll and talking about politics. And I thought this is interesting just to kind of bring it back to one of the major conversations at hand. And no matter what your news feed, you're hearing a lot about the election. So of those financial folks that were polled, a slight majority think there'll be a new President Trump will win the election. But I thought this is really intriguing because I'm getting asked a lot. I'm getting emails from clients a lot about which candidate for president would be best for the economy and best for the stock market. So again, these people maybe pay attention more than the average person, but they don't know for sure. But you can see while only half and half think, who's going to win the election, you can see there is definitely more of a majority here. 60% believe President Trump would be better for the economy, and 62% believe a President Trump would be better for the stock market, which I thought was really interesting. So I guess we'll have to wait and see. I think that could, anything can happen until November. But regardless, which economic issue would be the highest majority for policymakers in the next administration? 48% say debt reduction is the biggest concern. So not too surprising there. I think that's top of mind for a lot of folks. But Zach, do you agree with the put you on the spot there? What do you think about the politics, the economy, and the stock market? Who do you think?
Yeah, it's interesting because I think that we kind of have a known quantity a little bit with Biden and what their economic plan is. Certainly some unfriendly things when it comes to regulation, a very aggressive FTC, Federal Trade Commission, breaking up companies and putting stops to mergers, more regulations, potentially higher taxes, higher corporate tax rates. So we kind of know the playbook there. Trump's a little harder to figure out, because there's some very not friendly
big
policies.
Unknowns.
Well, there's some unknowns, but there's also some things that would be very inflationary, which is if you go back to what the biggest risk is to the economy, well, it's resurgent inflation.
Mm-hmm.
If he said it on one of the interviews a couple weeks ago that his plan is to deport millions of people that are in this country with a labor market at 3.8% unemployment.
Plus
that's a very
tariffs.
it's a very inflationary policy.
We'll
right?
see if this is campaign bluster or if there's some teeth behind this.
Yeah.
Time will tell.
His protectionist policies, the tariff policies, inflationary, higher interest rates, right? So yes, on the regulatory side, it almost certainly would be less aggressive, than the Biden administration. I'm sure whoever he puts in as the FTC chair would not be as aggressive as Lena Khan. But if you look at what is the biggest risk to the market and the economy, and you say if you say it's resurgent inflation, there's some very inflationary policies that
I agree.
Trump
that's
is out there
I was
talking
surprised
about.
a little bit by that. Almost 2/3 of the respondents thought Trump would be better for the market, and 60-40 for the economy. So, listen, we're trying to be as agnostic as possible. A lot of smart people on either side of that conversation. So the last slide here I wanted to share with you is to be a little bit more proactive here. I'm putting myself on the spot, on the hot seat. Where might be a good place to deploy capital at the moment? Where can we find some value in the marketplace? Markets are at all-time highs. Where does that leave us to deploy some capital? So the idea that I wanted to share is small cap stocks, particularly value stocks here in the US. And the first chart we started with this morning talked about how the markets are near all-time highs. The large cap companies are near all-time highs. But if we take a look at small caps, the all-time high was set in November of 2021. That's 2.5 years ago, which is really incredible to think about. The all-time high was set at 2,442, and the S&P as of this morning is the Russell as of this morning is trading at 2035. So that's a 20% below all-time highs. It implies there possibly could be some value coming down the road. Now remember, in November of 2021, when they hit that first all-time high, everyone knew that inflation was coming down the road, and that's what happened. And then the Fed has so far successfully fought that, yet haven't yet reduced rates. So I think that's kind of the variable that's influencing this. But if you have time, which is always the case for investing, it might be prudent to look towards deploying some capital in small caps and seeing if they can continue to recover and maybe approach all-time highs. So that's just one idea for you to take away. Always happy to field questions if you have an individual question. So with that, my friend, I turn it over to you. What's going on?
Yeah, with the with small caps too, if your forecast is for rates to decline, small companies are generally more interest rate sensitive, just because that they don't have the ability to take on as long dated debt as larger companies. They typically have to roll their debt more often, typically at higher rates, typically higher debt ratios to small companies. So if your forecast is for interest rates to eventually fall, small caps would be the beneficiary of that. And you kind of see that on days where the 10-year kind of trades down. You see the Russell 2000 index participating well. My first chart is just an expansion of kind of what you were talking about a little bit, and I'm going to talk a bit about valuations and where the valuations stand currently, and then also a little bit about what they could mean and what they couldn't mean. So if you look across the various asset class spectrum, the green diamonds is where things were on January 1st, 2023. The dark green circles is where they are currently as of end of last quarter. And the zero line is the 25-year average valuation. So this is really indexing it to itself over the last 25 years. And if you look at even, US large cap companies are nearing that one standard deviation above their 25-year averages. US large cap as a whole is actually above one standard deviation. And you kind of look, okay, well, what's below? And that's developed international, emerging markets, bonds. Small cap is right around its 25-year average there. And so you kind of look across the spectrum and see, where things are trading relative to itself, in the history. And what really jumps out is just the mix between stocks and bonds. And so, what I'm doing a lot for clients who have balanced portfolios, who have likely had dislocations in their asset allocation. Equities have performed quite well. Bonds have performed quite poorly. Likely there's been drift. If you had a 60-40 target, it has likely drifted if you haven't done any rebalancing recently. So with that in mind, it could be a good time to revisit your asset allocations and rebalance back to target, selling some of your equities, purchasing some of the bonds, to get that back into equilibrium, to the target that you want to have. And you'd be purchasing things that are at lower than average historical valuations, selling things that are above it. So I think that's one actionable item that you can kind of take away from the valuation mix there. I did also want to, I've looked at this next chart, been looking at it for 15 years. We did finally have a brief period of international outperformance. So we had a 15-year run, almost 14.2-year run of domestic US versus international equity outperformance. And these things typically do run in longer cycles. This was the longest one dating back to the early 70s. It used to switch more often. I think kind of before the United States really became the home of the internet and the tech company, in the early 2000s after the great financial crisis, in 08. But it does tend to happen. You don't necessarily know when it's going to happen. But we did have a decade from 2000 to 2008, 2009 where international outperformed by a cumulative 65% over 7 years, right? So that's a long period of time where international has outperformed, and it hasn't paid to hold an international allocation for much of the last decade and a half. But at some point that will likely flip, and valuations could be one of the reasons behind it.
Yeah, it's a great chart.
The next one's looking at what P ratios can actually tell us. So a PE ratio is price over earnings. We take the current stock price over the earnings per share. and it gives you a ratio, and then you can
And I like to
compare
tell
that
clients at home,
ratio.
just to in a nutshell, that tells you how many years of current earnings for the company, how many years they have to earn at that to buy back all of their shares. So just
Yeah,
another way
exactly.
to kind of envision that.
Yep, absolutely. And what it can tell you is relative to either its own history, so a single company or single index, relative to other industry components, relative to other asset classes, and then relative to time. And I really like this chart because on a 1 year basis, it tells you nothing. On the left hand side there, that's a
A lot
scatter
of
plot.
dispersion there in that particular
Quite a
chart. I
lot of
love this chart
quite
too.
yeah, quite a lot of dispersion. I want to say this goes back to 1970, about 50 dots there, maybe a little more. And on a 1 year basis with a correlation of 7% tells you nothing. It really, the P's mean nothing on a 12-month forward basis. Um, on the right-hand side, you have a 5 year annualized forward basis, and it tells you a little bit more. It's still only a 30% correlation, right? It's not telling you like, hey, with PE here, this is what's going to happen. That's most certainly not the case. But it does have much more of a defined trend line, and it can tell you with a decent chance relative to where valuations could be otherwise that yes, a forward PE ratio of the S&P 500 at 19.8 probably will have a lower annualized 5 year return than a PE ratio of 14.8, right? And I think you can take that away. And where this really comes into play is not to say that over the next 5 years we're going to have low returns, but if you're doing income projections for retired folks or you're doing financial planning projections, you can take those assumptions that go into those models and play with them a little bit based upon where valuations are. So if you're running a financial plan for somebody or you're doing a projection out 5, 10, 15 years on income, you may want to reduce that return projection because it might just default to the average return over the last 30 years, which could be 10%. Like, oh, well, maybe we want to back that off a little bit and see what happens if our return projections are 6 or 7%. So I think that that's really the best way to utilize this ratio. It is most certainly not a timing mechanism, right? If you say, I mean, if you go look at that chart on the left hand side, PE ratios of 23, 24, there's a couple 40+% returns in there, right? I mean, it tells you nothing about the next 12 months. So if you use that as a timing mechanism to try to get out of the market or sidestep some sort of correction, you could be sidestepping a 40% return. So it tells you nothing about that. But I think it can help to just ground some of your longer term assumptions about what you think you can expect, from your portfolio.
Yeah, great. It's a great chart. So what does it tell us? As you said, hard to know.
Yeah.
What can we do in light of this information to stay diversified, rebalance? To your earlier slide, I'm always, whenever you see information regarding, hey, what if you rebalance on an annual basis versus let your portfolio run without rebalancing? It's surprising how much that little action of discipline can help improve returns over the long term, because it's systematically taking you from what's working well, selling at the top and buying things at the bottom, which of course is what we want to do. Very difficult to do in practice, but yeah, it's a great idea.
And my final one is going to show you an instance where PE doesn't mean all that much at all. And this might poke a little bit of a hole in your small cap plug there. Sorry, because in order to have a P ratio, you need an E. You need earnings, and if your earnings are zero or negative, you have no ratio. And if you're looking on an index basis, so the Russell 2000 is the small cap index. There's 2,000 companies that make it up. Actually, 1,918. 811 of them have no earnings whatsoever. And so they are excluded from the PE calculation. So if you go back to my chart, where's the value, the list of different asset classes with their PE ratios, and I'll pop it back up on the screen in editing here. You look at that and say, hey, small caps don't look too bad. They're pretty much fairly valued. Well, that doesn't really tell you the whole story, because if you remove or if you add back in the PE ratio of the unprofitable companies, and this is from Hamilton Lane Advisors, a great newsletter that I follow. That jumps from 15.3 to 85.7. The PE ratio of the Russell 2000 doesn't look as attractive as it did at 15.3. And so the S&P 500, not much of a concern at any given point in time. It's a 2 or 3 or 4% of the companies in the S&P 500 have a negative earnings. And so they don't have a PE ratio. It's not going to move it all that much. This is a much more significant percentage, right? 40% of the entire index is not profitable. And so their PE ratios do not contribute to the PE ratio of the index. And so I think that it's a really important thing to know, that when you just look at a PE and you just look at a ratio, what exactly it's telling you, and then what exactly are the components going into it, because it doesn't always make a lot of sense. It's not just small caps, it's also emerging markets, right? A lot of unprofitable companies in emerging markets that have this same effect. So I think this is just one thing that a lot of folks probably aren't aware of if they just casually are looking at valuations and PE, and probably even a lot of professionals aren't aware of, that it might not tell the whole story.
Yeah, and I think it's a great point. And with anything with investing, of course, there's pros and cons. And I think this particular bullet point, for those of us who do a fair bit of research, has been well broadcast. And so, just one final chart here I added here in post edit, because we're so savvy here. This is an interesting chart. This is from Apollo. And it's showing you what percentage of Russell 2000 companies have, in fact, been unprofitable over that time frame. So you can see it's been a general trend since 1995, where it was about 15%. It did kind of come towards a peak there of about 40% post the financial crisis of 2009, and it has continued to trend upwards. And I wonder, Zach, and maybe you can confirm if you've heard the same, but I wonder if there's two specific reasons for that. One is that, as technology companies emerge, there's, they're kind of in this early stage and they're not profitable. Think of Amazon, for example, which is of course a mega cap, but for a long time it was not profitable. It's just reinvesting in its growth. So I wonder if that's kind of become into play. But a second point that I think about too is, a lot of these smaller companies are getting their financing from private markets, as banks have stepped away since the Dodd-Frank legislation. And that means that their partners are not a bank, not a brick and mortar bank, brick and mortar bank, but in fact, some private capital folks on Wall Street who have an incentive that they succeed and are often giving them financing and also giving them advice on how to strategically grow their business. So, hopefully they have some better advice in their pocket, not of course all the time, but those are two ideas that, as we're thinking here out loud, could, push back a little bit on that narrative.
It actually makes the PE relative, if you look at just Russell 2000 relative to itself, it actually makes it less useful. Because if it was always 40%, right? If it was just always had a 40% unprofitable rate, then you could compare it to itself 20 years ago and it really wouldn't matter, right? If you're kind of looking at it from that perspective, comparing it to itself, not across asset classes, but if you're just comparing it to itself, in that band of standard deviations. But this would actually indicate that you really couldn't compare it to itself without normalizing it. Because if you look, hey, 20 years ago, the Russell 2000 PE ratio was this, now it's this. Well, at that point, there was only 15% or 20% of the index was unprofitable. And so there was a lot more of the companies were contributing to that ultimate ratio than there are now. So it is interesting. I do think you're right. It's probably really just capital, availability of capital, private capital, venture, private equity. They ultimately want to take the company public to provide an exit. I also think this just speaks to a little bit about just innovation in the economy. There's probably a lot more innovating. There's
sector
a lot more
rotation.
risk taking. Companies.
You compare this. I'd wonder. We can talk about this another time. But if you looked like 2007, right, when we're kind of at a trough there in negative earnings, I believe it'd be much different breakdown of sectors than it is today. Of course, almost 20 years later.
Yeah, I wouldn't disagree with that.
We'll have to wait and see, my friends. Well, like anything, unfortunately, with this particular idea, I'm a two-armed economist with, it could happen this way or it could happen the other way. So sorry about that, but I think it's something to investigate nonetheless. Hopefully you found some value in our time here today. We covered a lot of material from politics to small cap. So Zach, anything else before we go?
No, that's good. I think the value that we're trying to bring to folks is have some real conversations about things. And a lot of times we're discovering this stuff in real time with each other, right? I'm not necessarily looking at each other's slides ahead of time, which I think is interesting. It's a bit of a different model, so I like it.
Yep. And here we're else in 35 minutes, and if you're listening in your car to 2 times the speed, 16 minutes. Where can you get such information? I don't know. This is really thoughtful critiques here from your friends, Brent and Zach. So we'll be back in 2 weeks with more information. If you have any questions, please let us know. Until then, we'll see you next time.